I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. So we talked about that in depth. But if you're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up. And it has been going up. There's no question about that. And you're like, I'll just sit there and watch it go up. Be careful. We've been warning about a stock market decline for a long time. It's happening. I mean, by the way, the NASDAQ, people forget this because Wall Street is out to sell your stocks. And CNBC says up. The NASDAQ peaked in November 2021. Go look at a 3-year chart and say what was the all-time high of NASDAQ. It was November 2021, and it's been down ever since. Now, it went down and came back, and it's going down again. Okay, there's volatility. And if you're a day trader, fine, good for you. Good luck trying to pick the spots. But the fact is, it's been going down for almost 2 years, and it's going down pretty heavily now because the error is out of the tech balloon. There's nothing I see that's going to make that better. I don't think the Fed's done raising interest rates. We'll talk more next week about what could happen. Yeah, and I remember the 1970s. The stock market peaked. Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, okay, 1982 was the beginning of one of the greatest bull markets in history. Grant that. But 82 is 13 years. It went sideways. Now, again, there's volatility in dips and peaks. I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started. Number one, around 1,000 on the Dow. And when you adjust for inflation, because we had massive inflation in the late 1970s, it was still down. So that's 13 years. Well, we're 2 years into this dip, and the NASDAQ is nowhere near where it was 2 years ago. That's the first thing that's going to get worse because the US is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and that was the number. It was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, people don't realize when wholesalers and distributors build up inventory. That counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise. And particularly in certain areas, stuff goes out of style. And the fashion industry is notorious. Who wants last year's coat or whatever? So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September, sometime around mid to late August, after 2 pretty strong months. And they were strong. The consumers just hit the brakes. Now, they had done enough to make the third quarter strong. But going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. You go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. We were spending not spending. We were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that. But the deficit alone was about $2 trillion. A no Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, That feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit is used up and the interest rates are 20%. Some of them are 28%. You're going to double that balance in 3 years. If you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped down on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. Gasoline is what economists call the demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shut whatever it is. You're just going to buy the gasoline, even if you don't like the price. By the way, lately price has been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market is starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your